Good evening everybody and welcome to P1 Governance, Risk and Ethics. And here we are with class number 3 for the June 2017 sitting. Before we return to the class notes and pick up where we have left off, a reminder of what we've seen so far. The most important thing probably that I've said to you so far is that this exam is a very practical exam. And yes, we are indeed on now. Apologies for the slightly late start. This is a very practical exam. And the more effort you can put in, not just looking at the class notes, but actually looking at what's happening in the real world and applying your knowledge to those real world stories, or even working backwards, finding the story and trying to fit it to bits of the class notes and the syllabus, the better the position you're going to be in. Now we're nearing the halfway point in terms of classes, and once we get there we can start dropping in a question or two to see how these things actually get examined. We won't be doing that tonight. I don't think we're quite going to get to the position tonight, but next week we will be looking at a past exam question so we can see how this stuff comes up and how we go about approaching it. But before we continue on tonight, we do need to look at some stories from the last few days so we can see how they fit into what we have been studying. In terms of what we have been studying, just before we get there, the most important thing we've seen in the class notes so far are the 11 corporate governance base principles. You know, the judgment, accountability, responsibility, all of that stuff. Very important that you know what each of those words means, and also that you've got an example up your sleeve, so if you had to explain it with an illustration, you could. If you understand that stuff, you'll be a lot better at seeing it in stories. Talking of stories, what have I got for you? I'm not sure if I've mentioned this already yet, but if you want a ready supply of stories relevant to this course, and you want that to be available for free, there is a newspaper in the UK which is freely handed out on the street. They've also got a website, and it is called City AM. And if you go to cityam.com, pretty much all of the stories that I mention are going to be there. It is a daily paper, Monday through Friday, worth checking it on a daily basis to see what stories are there. For example, Snapchat. There you go. Snapchat. The company is called Snap. And as you may well be aware, they have recently gone public. In other words, they have issued shares on the stock exchange in the United States. And that issue of shares has had quite a bit of interest. The share price, I think, initially went up. It's been up and down, quite a lot of speculation. But the share price I don't really care about, not relevant for this course. What's interesting is that the shares they issued on the stock exchange carry no votes whatsoever. So the guys who invented this company don't want to give up any control. They just want the money so they can use it to invest in making the Snap company grow and grow. But they want to be in sole charge of doing that, so they don't want anyone to have any votes. Now this causes quite a bit of fuss, because if there are no votes, it means that shareholders cannot hold the directors to account. So, for example, they can't vote them off the board because the only people with votes are the directors. In the United States, you can issue shares like this. In a lot of countries, you are not allowed to issue shares that have two different voting structures. Everyone's got to have the same ability to vote. But in America, they let you do this, which is one of the reasons that they've issued these shares in America. They could have chosen to go to Singapore, London, but a lot of these countries won't allow what is seen as a fairly undemocratic way of issuing shares. So a good example there of where accountability is being denied to the majority of shareholders. Second story for you. Pearson, a company related, I suppose, to LSBF in some ways. Pearson is an education company and is probably most famous for publishing textbooks. And the biggest bit of the Pearson business is selling textbooks to American college students, of whom there are millions. And you might think that's a relatively safe business to be in. I mean, students will keep going to college, students need books. Can't really lose, can you? Well, yes, you can. Number one, students are becoming remarkably adept at finding cheap, and in some cases, probably illegally free online copies. So they stop buying the hardback and they'll take online because it's cheaper. And secondly, college admissions fell in late 2016. As a result, in January 2017, just 2 months ago, Pearson issued a profit warning that their figures were not going to be as good as previously thought. Now, this clearly shocked the stock market. Sometimes the stock market's got a pretty good idea that things are not going to be as good as the company's saying, and if that's the case, thanks to the good old efficient market hypothesis, those rumours have already been built into the share price. This clearly hadn't, because after the announcement, the share price fell by 30%. Now, that's obviously not good news. Bear in mind that was the 5th profit warning that Pearson had issued over a fairly short period of time, and as you can imagine, shareholders extremely unhappy, and rumours start that the CEO is about to get sacked. But that's not the story, because we're in March 2017, and the story in March 2017 is the chief executive has just received a 20% pay rise. So either he's done a remarkable turnaround since January, and in 2 months, how much of a turnaround are you going to achieve? Or this is looking a little bit dodgy. Well, the reason why the CEO has managed to receive a 20% pay rise, it turns out, is because he managed to hit his performance targets. Which seems pretty impressive when you read the stuff above on the screen. Because surely, if their main business is selling textbooks to American college students, and they've just issued a profit warning, does that not suggest that profits are lower than expected? So how's he hit his target? And the answer is operating profit hit its target, but once you subtract all the other stuff like depreciation, amortization, interest and all that sort of stuff, the final profit figure isn't a profit. It's a $2.5 billion loss. So the shareholders have lost, but because his target was not set on the final profit figure, it was operating profit way higher up the profit or loss account, he's managed to hit his target. What do we learn from this? Performance-related pay, nice idea. But it does rather depend on how you are judging performance. The shareholders don't get the operating profit, they get the figure at the bottom, profit after tax, dividends and after everything else pretty much. And you might argue that if we're going to judge executives and try to align their performance with what shareholders care about, if shareholders get the number at the bottom, shouldn't the executives be judged by the number on the bottom? Anyway, worth keeping an eye out for that one. I would imagine that chief executive is living on borrowed time. If he's still the chief executive by the end of April, I will be very surprised. My guess is rumours will get stronger that he's about to go, which means by the time it gets to the annual general meeting, I guess he'll resign rather than go through the embarrassment of being sacked by the shareholders. But we will see. We will see. One more story, a rather different story in today's City AM. Poor old Tesco's. Oh, they're having a bad time of it. Tesco's, of course, came up in the March exam just 3 weeks ago, so I doubt it's coming up on your exam as well. Tesco's have now been fined £129 million for overstating their profits 2.5 years ago. Tesco's has also announced that it's going to compensate those shareholders who bought shares and then saw an immediate nosedive in the share price and lost money as a result of this accounting overstatement. And that apparently is going to cost them another £80 million plus. So Tesco's have basically lost 200 million quid today. That's not good, is it? But it gets worse. Because Tesco's are planning to take over a company called Booker. Booker are a cash and carry company, so they're a supplier of Tesco's. And I believe Booker also are the parent company of a couple of smaller supermarket chains. And if you're in the UK and watching this, I'm talking, I think this is right, Budgeons and Londis, which would mean Tesco's, as well as their smaller high street shops, would now be taking over some of their competitors. And they're about to pay a very large amount of money for this. I think it's like 25 billion quid. So this is huge. And in today's newspapers, it is reported that Schroders, whoever they are, have said they are against this takeover and encourage other Tesco shareholders to also tell the chairman the same. Schroders are the third biggest shareholder in Tesco's. They are an institutional shareholder. They're an investment company. And institutional shareholders in the past tended to be relatively passive. But in recent years, institutions have become more active. So that's one learning point relative to the course. But whilst they are the third biggest shareholder, we are still talking about a shareholding of less than 10%. In fact, I'm pretty sure less than 5%. And because they've got a small percentage holding, I might describe that as saying that Schroders has a small stakeholder voice. Meaning if they moan, if they've, say, only got 4% of the shares, well, there's another 96% of the shares. So as a director of Tesco's, I'm not that bothered that they're moaning, because at the AGM, it's 96 versus 4. It's only a problem for me if they can get enough of the other 96 to join with them and start pushing towards 50%. Then I might have a problem. So why are Schroders complaining in the newspapers? Because what they're trying to do is to get others to support them and make that stakeholder voice louder. They have written to the chairman of Tesco's and expressed their concern about the takeover, and they could have just done that nice and quietly and kept it private. That way Tesco's would have known, but other shareholders wouldn't have known what Schroders thinks. So this is a deliberate policy to say, come on other shareholders, you know we're right about this, and if enough of us tell Tesco's don't do it, Tesco's will have to pull out of the takeover. We can't do it on our own. So this is all about advertising your position in the hope that others who think similarly lose their shyness and join your campaign. So an interesting example of an active institutional investor trying to get its way by getting other people to support it. And it wouldn't surprise me if other institutional shareholders of Tesco's have been contacting the chairman today to say they agree. We'll keep an eye on that one. Maybe before the end of this course, that whole takeover will be cancelled. Or maybe it won't. Let's see. Now actually there's one more story I want to tell you at this point. And it's about a company called Crest Nicholson, a building company. We are in March, and that means we are entering AGM season. A lot of companies in the UK have a 31st of December year end, and those who are fairly quick off the mark will be starting to have their AGMs around about now and all the way through April and May, and maybe some even early June. But for the next few weeks, there will be a lot of annual general meetings. The big hot topic this year is a lot of big institutional investors who invest in many big companies have made it very clear that if they think directors are overpaying themselves, they are not going to let them get away with it. Crest Nicholson had their AGM last week. And the directors' pay, 58% of shareholders voted against it. We have the first defeat of the season. And what I find interesting about this is not just that shareholders are making it very clear that if they think you're paying too much, they're going to do something about it. What's very interesting is the response of the Crest Nicholson directors. Because they've said they'll keep talking to shareholders, but they're not changing their plans. That's a bit brave, isn't it? Your shareholders make it clear that they don't want you to do this, and you say, well, we're doing it anyway. Well, let's face it, you've got a maximum of 1 year to turn the company's performance around enough to keep the shareholders happy to let you get away with this, because shareholders vote in directors and vote out directors. So you're making a very big stand here. Very brave move. You see, the shareholder vote on director pay is not binding. Every year, companies have to disclose quite a lot of stuff about directors' pay, which is what they paid everybody last year, and that's what got the 58% of vote against. But if the directors have already earned that money, it's difficult to stop that happening. So when you vote against it, you're saying to the board, we don't want this to repeat in the future. And companies also have to disclose their pay policies going forward. And on that bit, the pay policies going forward, every third year minimum, the vote by the shareholders on that bit is binding. So if they say no, you cannot have that pay policy and you'll have to come up with something different and put it to the shareholders again. In the past, shareholders had no say on this at all. If there was a vote, it was totally voluntary by the company, purely to find out what the shareholders thought. You could totally ignore the result if you want, and to a great extent, it's still like that. But watch out for this over the coming weeks. A number of companies have already said they want to change directors' pay plans and make them more generous. And already shareholders are starting to say, I cannot think there's any justification for this. There are going to be a lot of directors' pay arguments in the newspapers over the next few days and weeks. Enough! There's a little sample of stories showing you a few parts of the course that we've seen already. But now it is time to go back to the class notes. And we are in chapter number 2 and page 32. We've finished our history lesson and we are now looking at the code of corporate governance that we have in the UK as of now. This is an overview section. To a certain extent though, I've already gone into quite a lot of the detail with some of the stuff that's coming up when we saw this in chapter 1. The UK code has 5 sections to it, although the first 2, leadership and effectiveness of the board, I like to think of together. They're all about the board structure, committees, directors and stuff like that. Section D is directors' pay. Section C, accountability, looks at things like internal controls, risk management, the content of the annual report and financial statements. And since controls and risk management are checked by internal audit and the financial statements are checked by external audit, it will involve all the auditors as well. And then relations with shareholders is section E. The class notes are going to tell us which of the principles in the UK code come from which of the reports from history. You do not need to know this stuff here. Now I'm not going to go through and cross it all out because that will take a while and you get the point. It's been put in there for your interest, but you don't need to know which of the reports came up with which bits. Okay, leadership of the board. Every company... yes, apologies, there is a typo there. Every company should be headed by an effective board, which is collectively responsible for the long-term success of the company. an effective board, one board, collectively responsible. Now that means that in the United Kingdom, every director must sit on one board. And a little bit later, we will see what impact that has, and also that some countries don't have one unitary board. They often have two boards. Clear division of responsibility at the head of the company between the running of the board, which is the chairman, and executive responsibility for running the company, and that's the chief executive. And since we need a clear division, this means that the chairman and the chief executive cannot be the same person. Thirdly, the chairman is responsible for the leadership of the board and ensuring its effectiveness in all aspects of its role. So making sure that directors turn up to meetings, have read the information before meetings, participate in meetings, the committee structure's working, and stuff like that. As part of their role as members of a unitary board, non-executive directors should challenge and help develop strategy. Now, as we will see later in the notes, non-executives are deemed to have 4 roles in corporate governance, one of which is challenging strategy, and the other 3 we will meet later. The logic here is if you just leave the executives to it, they will come up with their strategy and just go for it. Since it is their strategy, the danger is they're doing what they want to do rather than what is good for the shareholders. Your typical non-executive has got experience from other companies and lots of it. So when the executives come up with a plan, we would hope that the older and more experienced non-executives would challenge that plan and say, go on then, that's what you want to do, sell me the positives and tell me what the negatives might be and what you're doing about those. I want a proper justification for why that is the right strategy for the company. Force them to justify it. Second section, effectiveness. We want the board to have the right balance to it, and that balance comes in a number of ways. The appropriate balance of skills, experience and independence. Well, I would add to that diversity as well. We want a bit of variety on the board. Men versus women, British versus international members of the board, older and younger. The more of a mix, the better in my mind. Variety is the spice of life, after all. It is often said that the business world is the old boys club. The problem being that people on boards simply appoint their friends who they went to Oxford or Cambridge with, or their friends from the same gentleman's club. And this means that the city is a closed shop. You get a job not based on merit, but based on who you know. To try and get around that, corporate governance says we need a proper, formal, transparent procedure so that people who are getting appointed have gone through that procedure and should be the best people available, not just the chief executive's friends. All directors should allocate sufficient time. There have been problems in the past where someone will be chairman of more than one big company. And the chairman is not a full-time 7-day-a-week job, but it's a pretty big job. And being a chairman of 2 big companies might be too much for most people. And then you've got people who are an executive on one board, so that's their full-time job, but they're also non-executives on a handful of other companies. Well, every non-executive job you have is another board meeting once a month, which means if you've got, say, 5 of these, that's probably 5 working days out of every month when you're not doing your main job. There must be a risk here of directors being spread too thin. Before you join a board, you need to be brought onto that board, and that is called induction. Once you're on the board, we're not just going to leave you there, we're going to make sure that you have all the appropriate training you need to carry out your director duties. Directors are making all the really big decisions at companies, and decisions require quality information. How do we know if we have an effective board? Once a year, the chairman of the board has to organise a board performance evaluation. And that could be rather difficult for us to consider if it comes up on an exam question. Most people, when their performance is being evaluated, it's relatively easy because you have a fairly specific job criteria. So for example, I teach all the P1 courses, I have to do the P1 materials, I do quite a lot of the P7 materials, the F8 materials, and also I'm in charge of our ACCA courses. So you could appraise me based on my teaching and my feedback from students, and because I run the ACCA division, you could also appraise me on ACCA student numbers, pass rates on all the papers, student feedback on all aspects of what we do, because all of that falls under my job title. But what about a chief executive? I mean, they're responsible for everything. So how do you appraise them? How do you appraise a chairman? So we'll need to have a think about that, because that I think is one of the harder areas of corporate governance. And a bit of democracy. Directors, like politicians, should be put to the shareholder vote on a regular basis, and that will help them to be accountable. Or in other words, if they do a bad job, the shareholders can vote them off. Talking of accountability, the board should present a balanced and understandable assessment of the company's position and prospects. Information for the shareholders. That will be done through the annual report and the financial statements, but also through the AGM. Companies may also be producing quarterly performance reports. Other stock exchange announcements will all help the board to present that assessment. The board needs to manage risk and internal controls, and since it is looking at that lot and the annual report and accounts, it's also got to make sure it is organised in terms of external audit and internal audit. And in order to manage those audit relationships, it's going to need an audit committee. As we have just seen with some real-world stories, directors' pay is a massively sensitive area. We need companies to be paying enough to get good quality people through the door. But whatever directors are earning needs to be, to a fairly big percentage, performance-based. You only earn your money if you've done a good job. As we saw at the start of this session, deciding how to measure performance can be rather tricky though. Just as there was a formal and transparent procedure for how we choose new directors to join the board, we also need that procedure for determining pay. That way, when people see how much directors are earning, there is a clear logical justification for why they've earned that money. Then the shareholders can judge if they agree with that justification. And finally, relations with shareholders. That means a regular dialogue, some of which will be done once a year at the AGM. But that dialogue can also be done by meetings with shareholders, through the annual report, and things like that. There is then a little example in the notes. I'm not going to do this exercise with you during class. The main reason being that, as with all the exercises in the notes, the answers come straight afterwards. I wouldn't be too concerned if I were you with having a go at part A, but this bit here would be a useful thing for you to practice and then go and take a look at the answer in the notes. To finish off this chapter, an evaluation of the importance of codes. Do corporate governance codes actually do any good? Well, presumably they must do some good, otherwise we wouldn't have them, would we? The arguments in favour of corporate governance codes, guidelines, rules, etc. is a fairly obvious one. They should lead to improved internal controls of companies, improved decision making. That should make companies more profitable. And as well as companies becoming more profitable because they're being run better, the very fact there is a code helps give investors more confidence that companies in that country are being run well. Arguments against. The Code of Governance puts new compliance issues on companies. The simple fact that you can't have one person running everything, you need a chairman and a chief executive, may well increase your costs if at the moment one person does both. Then there's all the non-executives you may have to hire, and the evaluations of controls, and the evaluation of board, and the evaluation of risk management, and the fact you need an audit committee, and you might have to have internal audit that maybe you didn't have before, and you can see that a lot of this is potentially going to cost quite a bit of money. There's also the issue, does one code of principles necessarily apply to every type of organisation? Maybe some organisations are different and need different solutions. Yeah, fair point. You could easily argue that if one country has a very tight, restrictive code, forcing companies to do a lot of things and not do a lot of other things, but other countries have more relaxed codes, those companies based where the code is tight have a lot of additional costs burdened on them, which is likely to worsen their international competitive advantage. We've had corporate governance now in the UK for 25 years. 25 years since the Cadbury Code, and that is plenty of time for PhD students to do their research. Which means we know a few answers. And the most common answer quoted is if you do a correlation exercise between those companies who consistently get high ratings for their corporate governance and price earnings ratios, there is a clear correlation. But the question is this: does good corporate governance lead to a more valuable company? Or can more valuable companies afford the cost of good governance? Which way round is it? Maybe it's a bit of both. But it's important for us to try and understand whether there is any causality going on here, or is it just that rich companies can afford to do this stuff? Because if they're rich already and they're doing it just to conform but it's having no effect, then that would be a problem. If, on the other hand, companies who do this see their value go up, then clearly governance has some power. I think it's more the latter than it is the former, but there could be a bit of both in there, I think. Okay, we move on now to chapter number 3. What we start doing now from chapter 3 through to about chapter 6 is we're going to take specific areas of the Code of Governance and look at them in a bit more detail. Starting with directors. Now, before we go and look at any of the detail in the notes, I think it might be a good idea to have a little pictorial overview. What does a board of directors typically look like? Chairman at the top, and then the board basically splits in two. The executives are led by the chief executive, the CEO. We'd normally expect a finance director, a CFO, and possibly a few other executives as well. But we are worried that the executives will defraud the company or run it incompetently. So we need some people to keep an eye on what the executives are up to, and they are called the non-executives. They are led by SID, the Senior Independent Director. Nothing to get too excited about here. There'll be quite a few non-executives, and when they have meetings, somebody needs to be in charge and organise that, and that's who SID is. And that is the main board. However, not the whole story. Because coming off that board are going to be some committees. And the three that corporate governance requires are an audit committee, a nomination committee, and a remuneration committee. And most of the members of those committees are going to be non-executive directors. Okay, we look now at board composition, starting by looking at the roles. The responsibilities and roles of the board are fairly basic. They are to come up with the company's strategy, run the company, ensure there's enough resources for the company to be able to follow through with its strategy, and in general act in the best interests of shareholders. Nothing really of much excitement there. But then we get to something that's a bit more interesting. Unitary versus two-tier boards. As noted a few minutes ago, in the United Kingdom, we must have one board. And the main reason for that, oops, sorry, it's not there, is it? It's there. Is that all of the directors on that board have an equal legal duty. So I don't really care if you're an executive or you're a non-executive. If you're on that board, you're a director, and therefore you share those legal responsibilities with all the other directors. And if you're all equally responsible, you've all got to sit in the same room in meetings. Unitary boards usually have around 10 to 12 members. But if you can have a unitary board, and unitary means one, is that suggesting that there is also a possibility of running your company with two boards? And as you can probably imagine, the answer to that is yes. So how does a two-tier board work? Well, we've just seen that on the unitary board, we have the chairman, we have some executives, and we have some non-executives. In a two-tier board structure, a supervisory board sits on top, and there's a management board underneath. The supervisory board will be the company chairman and the non-executives. The management board will be run by the chief executive and any other executive directors, and you might want to have some senior management people who aren't directors on that board as well. The management board runs the company. The supervisory board, strangely enough, supervises the management board. And in order to be able to supervise what that board is doing, it means that the chief executive is going to have to attend supervisory board so they can go and report what the management board are up to. This is a very common structure overseas, especially in Germany, for reasons we will consider in a few minutes' time. And whilst it is the norm for German listed companies, it does get a bit of use in the UK. Imagine, for example, a school. The school is run on a day-to-day basis by the headmaster or headmistress, probably supported by a small number of deputy heads, because the head can't do it all on their own. But that's not the end of the story with schools, because once a month there will be a governor's meeting for that school. The head will be required to go to that governor's meeting and answer questions, present information on how well the school's done in the last month. And that governor's board for schools is basically the supervisory board that you see up there. So same idea, but not for listed companies, for something else. Schools, a similar thing works in hospitals as well. So that is a two-tier board structure. Why? Why not just put everyone in one room? Well, one benefit is that because you've got two levels of decision making, Putting the non-executives on their own supervisory board, which is above management board, makes it clear that the non-executives are senior to the executives. So if the executives come up with a strategy and the non-executives don't like it, well, that's the end of it then. You might also ask that the split allows the non-executives to meet without executive interference and intimidation. And a third thing you might say about the benefits of two-tier is that because you'll have more directors in total, because you've got 2 boards to run, that means there are a lot more seats available on one of the boards. And that means you could, if you wanted, put a lot of different stakeholder groups on the supervisory board. If you've only got 12 board seats in total and a unitary board, well, of those 12 seats, you've got the chairman, that's 1 gone, chief executive 2, chief finance officer 3, senior independent director 4. I doubt there is enough space on that board to have employee representatives, customers, suppliers, the environment, local community. There's too many stakeholders. If, on the other hand, you've got 2 levels of board, you let the management board run things on a daily basis without interference, but every so often, the chief executive must report that performance back to a supervisory board. And because that supervisory board has no CEO, no chief financial officer, you could, in theory, decide to put quite a few different stakeholder views on your board to help balance it out. Problems with the 2-tier approach? Well, 2 levels of decision making, management committee first, then supervisory, sounds like good control, but 2 levels of decisions is not very dynamic. It is likely to slow down decision making to a crawl. The fact that you've got 2 boards and therefore a lot of people involved in decisions could well mean that you don't get a decision at all. So the United Kingdom is not interested in this, but plenty of foreign countries are. The next thing we're going to see in the notes, non-executives, is fairly important. So I think at that point it makes a lot of sense for us to have a short break in proceedings. I'm just going to turn this presentation off briefly and then turn it back on, so please don't be alarmed.